I'm Charlotte McLeod with the Investing News Network, and here today with me is Lynette Zang, Chief Market Analyst at ITM Trading. Thank you so much for joining me. Great to meet you in person. Thanks for being here.
Thank you for having me. I really appreciate it, Charlotte.
Really excited to talk with you today because I've been watching your recent videos, and one of the topics it seems like you've been covering is this idea that we're heading toward a black swan crisis, probably in the first half of this year. So that sounds like a big deal. That's where I wanted to start with you today.
Yes, and that's because there is a transition and that's happening from one interest rate benchmark, the London interbank offer rate, the LIBOR, into, in the US, the SOFR. And that's never been done before. And we're talking about notionally that's contracts that have to convert 610 trillion, but that's just the notional value. So this could be quadrillions of dollars worth of contracts that will be shifting from one interest rate benchmark into another one. And that is a tectonic shift, and nobody's talking about it.
No, nobody is talking about it. I mean, I've heard you speak about it, but I wondered if you could explain it in really basic terms, because I think people may not be quite familiar with what exactly is happening.
Okay. Well, the LIBOR, London Interbank Offer Rate, was created in the 1980s and is part of every single contract, like mortgages, credit cards, student loans, any kind of debt contracts. And it's a stated rate. So in other words, there's just a small group of banks that would get together every day and they'd say, well, gee, if I were going to borrow money overnight, this is how much I would be willing to pay. And if I were going to loan money overnight, this is how much I would require to do that. And during the financial crisis, surprisingly, and I'm being facetious, Wall Street took advantage of that and they manipulated the rates to their benefit. So I can remember like Goldman Sachs made $1 trillion and their clients lost $1 trillion. And I don't think that's by accident. So that got leaked. And once it got leaked to the public, then they could no longer, they had to shift. The Bank of England came out and said, okay, it was supposed to be 2021. The LIBOR would no longer be used. And so after that, a number of central banks started to work on creating a new benchmark. And in the US, it's called the SOFR, but they couldn't get Wall Street to adopt it. So they actually had a forced adoption in as of January 1st, 2022. All contracts had to be written with the SOFR interest rate in there. So here's the problem, because that doesn't really sound like that big a deal, right? Except that even jury-rigging the numbers, they could not get the SOFR to interest rates to the same exact level as the LIBOR. And that means that every single contract will be revalued. Okay, now if you're talking in the quadrillions, and it doesn't matter, this might be pennies, but a couple pennies on one contract is not a big deal. But when you're talking about the trillions and the quadrillions, now imagine that all of these banks or all of these corporations that hold these contracts that will be suddenly revalued on June 30th of 2023, their current price, stock price, is based upon the current valuation of the contracts. So if that changes, what does that do to the valuation of all the banks and all those corporations?
Yeah, I mean, can you spell that out for us just so we understand?
Yikes.
Yeah, yeah.
I mean, really, that's like an earthquake in the financial system. And because of this difference, they couldn't get Wall Street to adopt it. And by the way, for you and me with credit cards, mortgages, student loans, car loans, those kinds of things, they put in a firewall so that we don't have the right to sue if you open up your statement and your mortgage payment went from X to Y all of a sudden. So it changes everything. This historically, this level of change has never been attempted before. And I hope I'm wrong, but I don't think they can do it. And Wall Street doesn't think they could do it, which is why they didn't adopt it easily.
Okay, so we can now, I think, start to see at the high level, what is this going to mean? If you're, an individual person, how does this impact you? We get to June 30th, then what possibly happens?
Well, number one, I think they're getting ready for a bail-in. The recent piece that I did on the FDIC based upon a recent meeting that they have on banking resolution, and the fact that they only have a little bit more than a penny for every insured dollar, and plus they've got a whole lot of money that's in the system that is not insured. And that kind of concerns me with like small businesses, because if you're counting on putting the money in the bank to pay your payroll and you have more than $250,000 in there to cover it, that could create also a lot of problems.
It could, yeah. So this is very, very interesting. And, this is something, as you mentioned, that is not getting noticed. We have also all these factors that people are looking at. And one thing I wanted to go back to with you, because we talked about debt quite a bit in our last conversation, which was midway through last year. Right now, debt is in focus again because of these debt ceiling concerns. So what can we say about that?
Well, I do think that we will end up raising the debt ceiling. But what we don't know is all the partisanship and how far will our government push us. I mean, in 2011, we were downgraded from a AAA rating to a AA rating. Will they push us into that next downgrade? And if they do, there are different holders of our debt that might not be able to continue to hold our debt. And we're already seeing the lack of liquidity. I mean, that really started happening in the Treasury market in 2015.
Right. So, okay, that's interesting as well, because, we see these things like, okay, we raise it again, and it always seems like there's a way to get around these consequences. But as you mentioned, if it gets downgraded, I guess that's part of the consequence.
And you can only kick the can so far down the road. And unfortunately, I mean, the key tools that the central banks have are interest rates to regulate the rate and speed of the inflation. I lived through a more rapid, because I was around in 71, and I remember that high inflation and all of the turmoil. But there are also really telling signs that you see every single time that there is a currency shift. And part of that is war. And there's, unfortunately, I think we will see a World War III happen, because that's distraction. And there's a lot of chaos. And I mean, anybody, even if you don't understand this, I think everybody can kind of see that everything just feels off and uncomfortable. You have to trust yourself. Even if you don't understand the details, trust your gut. And don't just say, oh, well, they must know what they're doing and have control. And it's that rapid inflation that has an impact on consumers, and not just consumers, but on confidence of the public. And that's the only thing that's holding it together. So because we've basically been anchored at zero interest rates, and we have this looming shift, I mean, doesn't it trouble you that nobody's talking about it?
Well, and that's why it's good to have these conversations. And so here at VRC, where we are, I think, what's going on with the dollar, de-dollarization has been a massive topic of conversation. So let's check in on that, because you're mentioning this big currency shift, and a lot of people are talking about that, at least here.
Yes. And we'll look at what Saudi Arabia did just recently by saying that, yeah, they could accept the yuan, or they could accept the ruble, or they could accept gold for oil. And our petrodollar that was created back in the 70s that enabled the US dollar to retain its position as the world reserve currency, if the oil producing nations are now actually willing to accept other currencies, well, we don't have that petrodollar anymore, do we? And we've been working toward that. I mean, we meaning other countries, the BRICS nations, et cetera, have been working toward that end. That means that there's going to be a whole lot of dollars that are no longer needed, right? The petrodollar really created that market for the dollar, because if you were a government or corporation going outside of your border to buy anything, you had to use dollars to do it. But unfortunately, you know, we lose that status, and who's the plus in OPEC plus? Right?
Yeah.
Russia.
Okay, so we see this move away from the dollar from countries around the world. And what we also have been seeing, which I think is a great segue into gold, we've been seeing record gold buying from central banks. And
Yes.
wanted to bring that up with you because, again, in our last conversation, we were talking about central bank digital currencies. And I think a lot of people look at this and say, what exactly are they doing? They're buying gold. They want to make this shift. What are they thinking?
Well, why do you buy gold? Because gold is, according to the Bank for International Settlements, the only financial instrument that runs no counterparty risk. And with everything that's happening across the globe in politics and geopolitics, and the transition from one currency system into a new currency system, that's a violent shift. That's very violent. So the reason why I believe you are seeing central banks accumulate massive amounts of gold is so that they retain their power through this shift. And that's exactly the same reason why I buy gold, because I want to retain my power. I want to have my freedom. I want to have my choices. And you know, it's not just the central banks that have been front running this, it's also the 1%, the elites. And you know that by looking at the index of the ultra rarities. So this is a collectible coin, this is not an ultra rarity. But there are coins like this that are so rare that they go for $8 million, $15 million for 1 ounce of gold, one coin. And if you look at that index, number one, it's broken out to new highs, and that person at that elite level, well, they're likely to be either somebody that writes the rules or have the influence over those people that write the rules. And if you listen to the FDIC, what they were saying was, well, the people that are out here, the institutions that really need to understand what's going on, no problem. They have their attorneys, they have their accountants, but we don't want the general public to understand what's happening and that they will get bailed in, because then what do? You make different choices. So it is definitely the central banks, and who knows more about money and what they're doing to it than them. I mean, here, we'll play central bank, right? And every time they do this, then the money that's already out there loses more value.
Yeah, and so here at the conference, I think there's a lot of people who are looking for advice on what do I do with all of these big things going on. And the starting point, usually what we hear from people is gold and silver. You want to have your physical gold and silver. I want to go down, I don't know, a little bit of a scary path because, you know, what happens, is there a situation where, you know, the government, central banks could ask people to give up their precious metals?
100%.
We've seen it before.
I mean,
but
and not only have we seen it in this country, but we recently saw it in Ghana, where they've required their gold producers to sell their central bank 20% of their gold at the local currency that has officially lost 57%, which means it's probably more than that, because desperate governments do desperate things. And personally, That's why I only buy the collectible pre-1933 coins. You know, I had an uncle who, I feel like I've been groomed for this moment in time with all of the trading that I've had. You live long enough, you can look back and you can see it. And, you know, when I was 10, so that would have been 1964, my parents and I were visiting him. And he said, come here, I want to show you something. And he took us in a back bedroom where he had 2 tall floor safes. And he opened the door of those safes and he said, if anything should happen to me, Aunt Bertie will be well taken care of for the rest of her life by what's in these safes. So I turned around and looked. Now, I was 10. I don't think I comprehended. In fact, I know I did not really comprehend it. But basically, in 1964, it was illegal to hold more than 5 ounces of gold other than in pre-33 form. So not only did he have, knowing what I know now, at least 3,000 ounces between those 2 safes, but he could use them in the normal public because they were legal without oversight. That influenced me. And I didn't even realize it until one day when I was writing and I said, if you were alive like I was in 1971, and then I went, oh yeah, I remember that. So, you know, you live long enough, you can kind of see how you're guided.
Okay, really interesting, because a lot of the time people really advise to go for, you know, the current coins, you know, all the ones that are the latest one. But that's a great point.
Well, think about it.
Yeah.
What can you hold inside of an IRA? Okay, you can only hold bullion in an IRA. Well, if you're holding bullion in an IRA, how easy is it to say, we're confiscating it, well, they won't use the term confiscation, but we're going to take it, but don't worry because we're going to leave you lots of this fiat money, right? And even paying a premium because, again, they know what they're doing to the currency and its purchasing power. So let's say that spot gold, which is Wall Street's term, it's a contract, was at $3,000 an ounce, right? Yeah. And they say, but don't worry because we're going to pay you $4,000 an ounce. Well, that's pretty much what they did back in 1933. And then after they got the gold, they revalued it to you know, the currency, and the currency lost a lot of value overnight. So people that don't think it can happen here just don't look at history.
Okay, so 2023, I don't know how I'm feeling about this year at this point.
Me too.
Yeah, so as we wrap up though, you know, what would you leave investors with?
You know, you've got to be, you know, whether you believe in gold or you don't believe in gold, this is the primary currency metal. And when they do those overnight resets, they take this that has no intrinsic value and they revalue it based on how much of this they've printed to the gold. It is a true portfolio diversifier. You want to take some risk? Okay, you do whatever you're comfortable with. That's what everybody needs to do. But quite honestly, have a foundation of real money that is outside of the system. That is in your possession, because regardless of your perception, if you don't hold it, you don't own it. So, I mean, I really have a whole mantra to it because, you know, people will say, well, you can't eat gold. Well, you're not eating this either, but you'll be able to convert. Well, I use silver for barterability. But you want to be as secure as possible and independent. So food, water, energy, security, barterability, wealth preservation, community, and shelter. These are the things that we need to make sure are secure and surrounding us. And maybe community is the single most important part of that, because one person can't do everything. But you really need to be as independent as possible, because if all your money is held in the system and this dollar goes away, then you are completely dependent and you lose all your choices. And get it done quickly, because we're not that far from June.
Okay, so I think that is where we'll wrap up for today. Really great advice for everybody. I think there's something that everyone could learn from this interview. So thank you so much.
Oh, it's
Great
been
to
great.
have you. Yeah. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Lynette Zang with ITM Trading.